Welcome to the Deep Dive.
Yeah.
We're your shortcut to really getting what matters in today's, well, complex information landscape.
Yeah. We cut through the noise.
Exactly. We
Yeah.
extract the critical stuff, give you that actionable knowledge so you walk away informed, ready to connect the dots.
And today, we've got a good one.
We do. We're plunging right into the recent first quarter 2025 earnings call from Stryker. They're a huge player, a real leader in MedTech.
Mm-hmm.
And this quarter, well, it paints a really interesting picture. Growth, strategy, lots to unpack.
It really does. Kicking things off, the big picture view, Stryker delivered a really robust organic sales growth. We're talking 10.1% for the quarter.
10%, wow.
Yeah, and what makes that really stand out, what signals their strength, is they did it with one less selling day compared to Q1 last year.
Oh, okay. That's tough.
Right, and they were up against a pretty tough 10% comparable from a year ago, too. So it really speaks to like a deep underlying demand for what they offer.
So it's not just a flashy number. It's real commercial execution, even with headwinds. How did that translate to the bottom line? Was it just as strong?
Oh, absolutely. Adjusted EPS came in at $2.84 per share. That's up 13.6% over Q1 2024.
Okay, solid jump.
Very solid. And this strong performance, it wasn't just sales. It was really driven by that robust top-line growth. Yeah, but also significant margin expansion. Kind of a powerful 1-2 punch for profitability.
Right, sales and efficiency working together.
Oh.
Okay, let's get into that. How do they pull off such a strong quarter? If we look closer at the sales details, what segments, what regions really stood out?
Well, the overall strength really came from sustained demand pretty much across their whole product portfolio, plus, really vigorous commercial execution.
Right.
The U.S. performance was particularly strong, really leading the charge.
You mentioned double-digit organic growth in the U.S. in some spots. Where exactly did they see that kind of explosive growth?
Yeah, absolutely. Double digits organically in the U.S. for trauma and extremities, neurocranial, medical, endoscopy, and instruments. Big drivers.
Oh, that's a broad base.
It is. And even in more mature markets like hips and knees, they still posted solid high single-digit growth in the U.S., which, shows consistent demand and their strong market position.
That's a powerful story domestically. But what about internationally? Are they seeing growth outside the U.S. too?
They are. Healthy growth across actually a broad range of international markets. They called out Australia, New Zealand, Japan, Europe, seeing notable strength there.
Okay.
And what's really crucial here is how management sees it. They view international as a significant catalyst for future growth. And when you think about it, international is only about 25% of their total sales right now.
So huge potential runway there.
Exactly. A substantial, largely untapped runway for expansion.
Got it. Okay, beyond the big picture, can you give us a quick run through of maybe some segment specifics, anything that, jumped out or maybe surprised you?
Sure. MedSurg and Neurotechnology, that saw 10.7% organic sales growth. Orthopaedics was 9.3% organic. Within that, the U.S. knee and hip businesses showed really solid momentum.
Driven by?
Fueled by their Mako robotics platform, definitely, and also the Insignia hip stem.
Okay.
And trauma and extremities, that was particularly remarkable. 15.2% organic growth.
15%.
Yeah, largely driven by the really successful launch of their Pangea plating system. Seems like that's a big hit.
Clearly. Now, on the flip side, were there any areas that were maybe flat or saw slight declines? And what does that tell us about how they're managing the portfolio?
Yeah, good question. U.S. spinal implants saw flat organic growth, and that actually leads right into the recent divestiture of that business. So that makes sense strategically.
Okay, shedding that piece.
Right. And then U.S. other ortho had a slight organic decline, 1.9%. But this wasn't necessarily market weakness. They said it was primarily due to a strategic shift. More customers opting for Mako leases instead of buying the systems outright, and also a decline in bone cements. So it points more to a changing business model, maybe, rather than a fundamental demand issue.
Ah, okay. That clarifies things.
Yeah.
Let's pivot to profitability then. You mentioned margin expansion was a key driver. How exactly did Stryker achieve that? Given all the pressures companies face today, inflation, supply chains.
Yeah, it's impressive. The adjusted gross margin saw a really substantial improvement, 190 basis points. It hit 65.5% compared to Q1 last year.
Wow, nearly 2 full points. What was behind that?
Primarily a few things. Manufacturing cost improvements, positive pricing trends. They even saw less negative pricing in ortho, which is definitely a win in that space and a favorable business mix.
Business mix? You mean like selling more high-margin stuff?
Exactly. And that was partly helped by the NREA acquisition, bringing those higher-margin vascular products into the fold.
Okay, so those efficiencies, that better mix, it flowed down to operating income, even with, ongoing investments.
Precisely. The adjusted operating margin showed 100 basis points of favorability, landed at 22.9% of sales.
Nice.
Yeah. And that was largely thanks to those gross margin gains. Now, it was partially offset by increased SG&A spending.
Ah, okay. Where was that going?
Well, it's important to note that spending was strategic, primarily for integrating Inari, which takes investment, and also other growth initiatives. So kind of spending money to make money down the line, positioning for future gains.
Makes sense. And what about those less talked about lines, like other income and expenses or the tax rate and any impact there?
Yeah, adjusted other income and expense increased to $73 million. That was about $24 million higher than last year.
Why the increase?
Mainly higher interest expense. They issued some debt recently, September 24 and January 25, though that was partially offset by interest income they earned on their cash.
Okay. And tax rate?
The adjusted effective tax rate for the quarter was 13.7%. For the full year, they're expecting it to be somewhere in the range of 15% to 16%.
Got it. Okay, moving beyond the pure financials, let's talk strategy. Big moves. The NREA Medical acquisition was a major headline. What's the early read? How's it performing? Integration going okay?
Yeah, the Inari deal closed in late February, and the word is initial performance has been strong. Integration seems to be proceeding smoothly. Its results are now part of their vascular division.
Good start then.
Seems like it. And what's really exciting about Inari, I think, is that currently only about 7% of its sales are international.
Only 7%.
Yeah. So that represents this enormous, basically untapped future opportunity for Stryker to use its global network, its distribution muscle, to really grow that business outside the U.S.
Huge potential there. And then on the other side of the coin, they completed the sale, the divestiture of their U.S. spinal implants business. What signal does that send about their focus?
Well, it looks like it's about sharpening the portfolio, right? Focusing resources. And they also mentioned that from Q2 onwards, the international spinal implants business results won't be included either.
Okay, so a clean break from spine globally, more or less.
Pretty much. It clarifies their commitment to specific high-growth, high-margin areas, lets them allocate resources more efficiently, presumably.
Right. Now, the Mako Robotics platform, that continues to be just a massive story for Stryker, doesn't it?
Right.
Really sets them apart. What's the latest there? How's the expansion going?
Yeah, Mako is still a huge engine. They had their best ever Q1 for Mako installations globally. Utilization rates are strong too. It just keeps driving growth in their hips and knees businesses.
And what's next for Mako? Any new applications coming?
Definitely. Mako Spine is on track for a full U.S. commercial launch in the second half of this year, 2025. And Mako Shoulder is slated for Q1 2026.
Shoulder, interesting.
Yeah. And they also just launched the new Mako 4 system. It's got like a larger monitor, but actually a smaller footprint in the OR for faster setup, plus seamless integration with their newer guidance system. The idea is it should make complex procedures even easier.
Constant innovation there. Beyond Mako, what other key product launches really stood out this quarter? What else drove that success?
Well, several things are making waves. The LifePak 35 defibrillator, they said demand is robust, order book is strong.
Yeah.
And they're planning international launches to Europe, Japan later this year. Plus, it has a huge existing installed base, which is a nice future tailwind for upgrades and service.
Right, built-in market.
Exactly. And we mentioned Pangea, right? The plating system for trauma. Wild success in the U.S. driving that trauma growth. And they've got global rollout plans underway, Australia, Canada, Japan by early 2026.
So taking that U.S. success global, what about their broader ortho portfolio? Knees, shoulders?
Yeah, cementless knees continue to show strong growth.
Yeah.
And they highlighted some impressive 10-year survivorship data, over 99% from recent studies. That's a powerful clinical selling point.
Definitely.
And their shoulder portfolio is also a real highlight. Just an array of new products: Perform System, Fracture Stem, Reverse Stemless, patient-specific stuff with Shoulder ID, Pyrocarbon, all coupled with their Blueprint software. Yeah, it uses AI to help surgeons plan. This whole comprehensive offering really cements their leadership in shoulder replacement.
Seems like innovation across the board. Anything new from the NRE side hitting the market yet?
Yes, actually. Arctics. That's NRE's recently launched first arterial product. Apparently, it's getting a favorable customer response already, expanding their reach within that vascular space.
Good to see that integration bearing fruit quickly. Okay, let's shift to the outlook. Full year 2025 guidance. What's the main takeaway message for us?
The big headline is they raised their organic net sales growth guidance, now expecting 8.5% to 9.5% for the full year.
Okay, up from before. That reflects the strong Q1 momentum.
Exactly. Shows confidence in their trajectory, strong demand, continued commercial momentum.
The EPS guidance was reiterated, right? Not raised. Despite the higher sales forecast, what's going on there?
Yeah, that's a sharp observation.
Okay.
They kept the adjusted EPS range at $13 to $13.45 or 45 cents. The key thing is this guidance now explicitly includes the net impact of tariffs.
Tariffs.
And also the dilution from the NREA acquisition, which was actually excluded before. So yes, sales are stronger, but these headwinds are now fully baked into that profit outlook.
Tariffs.
Yeah.
Seems like a recurring theme for global companies. How big an impact are they expecting, and how is Stryker planning to handle it? You said $200 million?
Yeah, the estimate for 2025 is around a $200 million hit from tariffs based on current policies. It's significant.
Definitely. So mitigation.
They have a multi-pronged strategy, leveraging that sales momentum we talked about, getting positive pricing where they can, being disciplined on spending, supply chain optimization. And actually, they mentioned getting some help from better than expected foreign currency movements.
Okay, pulling multiple levers.
Right. And it's interesting, they noted that tariffs mostly hit their cost of goods sold, right?
Right.
But a lot of the mitigations happen in operating expenses, so it requires this careful balancing act internally.
And despite that $200 million headwind, they're still targeting margin expansion for the full year.
Yes. They reiterated their goal. Approximately 100 basis points of operating margin expansion for the full year, which really is quite a testament to their operational discipline and the underlying strength of the business, even with those pressures.
Very resilient.
Mm-hmm.
How's cash flow looking? And what's the plan for deploying capital? Still looking at M&A.
Q1 cash from operations was $250 million. They say they have strong liquidity and, yes, actively pursuing M&A, particularly those tuck-in acquisitions, which they feel have a really high success rate for them historically, expanding the portfolio bit by bit.
Okay. Shifting gears slightly, the broader market environment. What's management seeing in terms of procedure volumes, capital demand, any signs of things slowing down?
Nope, seems steady. Procedural volumes remain robust, they said. Strong capital product demand, too. Their order book is elevated. They mentioned about 6 months of visibility.
That's good visibility.
It is. And crucially, management confirmed. No signs of slowdown, no order cancellations. That's pretty reassuring for the overall health of the MedTech market, at least from their perspective.
And what about that shift? Procedures moving to ambulatory surgical centers, ASCs. Is that trend still helping Stryker?
Absolutely. That continues to be a positive tailwind for them, especially for knees and hips, as more of those surgeries move into outpatient settings. Their products and service models often fit well there.
Makes sense. In this, uncertain economic world, how recession resilient do they feel their business is? Are they insulated?
Management seems pretty confident here. They view most of Stryker's procedures as, urgent or medically necessary. That makes the business largely recession-proof in their view.
So non-elective, mostly.
Right. They think maybe only minor areas, perhaps some capital equipment like hospital beds, might feel a pinch in a broader slowdown. But overall, the core business, pretty insulated because people still need these procedures.
Okay. One last check. Any worries about the FDA? We've heard headlines about staffing, approval times. Any impact on Stryker?
Doesn't sound like it. They said no major slowdowns in product approvals are anticipated. Apparently, those earlier staff reductions at the FDA were largely temporary, and positions have mostly been refilled. So, from Stryker's viewpoint, things seems to be back on track regarding regulatory processes.
Good to hear. Okay, now, time for that segment you've been waiting for, a chance to maybe stretch our thinking a bit.
Yeah.
But let's be crystal clear. This is not financial advice.
Absolutely not. Purely thought-provoking discussion. No recommendations here.
Okay. Lay it on us.
So think about this. Stryker's stated ambition, international markets. The fact that only 25% of their total sales are currently outside the U.S., and their big new acquisition, NREA Medical, only 7% international sales.
Right. We covered that huge gap.
Exactly. So here's the idea, maybe a bit outrageous, but plausible. Consider the multi-year thesis of Stryker's global market unlocking.
Okay. Unpack that.
Management themselves called international markets a significant catalyst for future growth. They acknowledge the time delays, complex regulations like EU MDR in Europe take time. But imagine the compounding effect.
Right.
When market-leading products like Mako, like LifePak 35, like Pangea things that have seen explosive U.S. growth when they fully penetrate major international markets, Japan, Europe.
So it's not just expanding existing line.
No, it's about introducing these high-demand, really differentiated products into regions where their impact just hasn't been felt yet. That lag you see from the regulatory hurdles, you could actually see it as a hidden growth runway, a coiled spring maybe, for years to come.
Interesting way to frame it. So this isn't about the next quarter's earnings beat.
Not at all. This is a multi-year narrative, a thesis that Stryker can achieve sustained, maybe even accelerated growth just by replicating its proving U.S. success globally, using its current portfolio, plus the new stuff from Inari. Essentially unlocking a much bigger, untapped market for innovations they've already proven work.
It's definitely a compelling long-term strategic angle to think about.
Yeah, it's a structural growth story, potentially.
Okay, that's a truly fascinating perspective to consider as we wrap up here. So, to quickly recap, Stryker, exceptionally strong Q1 results. They raised their sales guidance, they're navigating challenges like tariffs strategically, and they're fueling really impressive growth through innovation, smart M&A, and a big focus on market expansion, especially internationally.
That sums it up well. Strong quarter, confident outlook.
And as always, please remember, this deep dive is purely for informational purposes. It absolutely does not constitute financial advice. Do your own research.
And maybe leave you with this thought to chew on. As you look at Stryker, or any company really, ask yourself, how do the strategic choices they make about where and how they deploy their latest innovations, geographically or different pricing models, financing, how do those choices ultimately shape their long-term market leadership and resilience in what's clearly an ever-evolving global healthcare landscape?